Silver isn't priced by supply and demand anymore. It's priced by something else. And once you understand how this market actually works, you'll never look at the spot price the same way again. I don't mean that in some conspiracy theory way. I mean it literally. The number on your screen, whether it's $28, $32, whatever it is when you're watching this, that number is determined by a market where 350 to 400 paper contracts trade for every single physical ounce that actually exists. Let that sink in for a second. For every real bar of silver sitting in a vault somewhere, there are 350 people holding pieces of paper saying they own it. And here's the kicker. The physical market is screaming one story, while the paper market is telling a completely different one. So let's talk about what's actually happening, because the data I've been going through doesn't match the headlines. Right now, we're in year 6 of what's called a structural deficit. That's a fancy way of saying the world is using more silver than it's producing. But we're not talking about a little shortage here and there. Since 2021, the cumulative gap between what we've mined and what we've consumed is over 820 million ounces. To put that in perspective, that's an entire year of global mine production just gone, vanished into solar panels, EV components, and AI server racks. Industrial demand hit 700 million ounces last year. That's a record. Solar alone has tripled its silver consumption since 2021. And before you say, well, they'll just use less silver per panel, here's where it gets interesting. They're actually using more. The new N-type solar cells, the ones that are supposed to be more efficient, they need 30 to 50% more silver than the old PERC technology. So much for thrifting. But the price. The price isn't behaving like you'd expect when you have 6 years of deficits and record industrial demand. It spiked to $64 in December, sure. Then the CME, that's the exchange where silver futures trade, they raised margin requirements in January. Suddenly, all those overcrowded long positions got squeezed out, and the price dropped. Despite the fact that the physical shortage got worse. I spent a week trying to reconcile this, and here's what I found. The COMEX silver market trades millions of ounces every single day through futures contracts. But here's the thing. Most of those contracts never result in actual delivery. It's just speculation, hedging, algorithmic trading. The paper market has become so massive that it drowns out the signals coming from the physical world. When industrial users are scrambling to find metal, when premiums on physical coins are 20 to 30% above spot price, when COMEX registered inventories are collapsing, the paper market just shrugs. Let me explain what registered means, because this is crucial. COMEX warehouses hold 2 categories of silver. Eligible is metal that meets exchange standards but isn't available for delivery. It's owned by someone who's just storing it there. Registered is metal that's actually available to fulfill futures contracts. It's the stuff that backs up the paper promises. In January 2026 alone, 49.4 million ounces disappeared from COMEX vaults. That's 4 times the withdrawal rate from January 2025. The registered category, the deliverable metal, has been steadily draining. And yet the price mechanism isn't responding the way Economics 101 says it should. You know why? Because the short side of the market is dominated by commercial banks. These aren't speculators betting on price drops. These are institutions managing massive positions, providing liquidity, and yes, suppressing volatility that would otherwise cause chaos in industrial supply chains. When silver tried to break out in December, margin requirements went up. When too many retail traders pile into long positions, the rules change to cool things off. It's not a conspiracy. It's just how the game is played when the paper tail wags the physical dog. Now let's talk about the supply side, because this is where things get really constrained. Global silver mine production is stuck around 820 million ounces per year. It's been flat for years. You might think, well, if the price goes higher, miners will produce more. That's not how silver works, Here's why. 70% of silver is a byproduct. It comes out of the ground when you're mining copper, lead, or zinc. A lead mine doesn't care if silver is $30 or $60 an ounce. They're mining lead. They can't just dial up silver production because the economics are good. They'd need lead prices to justify more extraction. This is what I call the byproduct trap. Silver supply is price inelastic. Even when silver hit $64, there was no supply response. There can't be. The geology doesn't work that way, and base metal prices haven't been strong enough to incentivize new mine developments that would happen to bring more silver along with it. I looked at the all-in sustaining costs for silver miners. We're talking $13 to $18 per ounce now, up from single digits a few years ago due to inflation in energy, labor, and equipment. So even at current prices, margins are decent but not spectacular. And remember, most primary silver miners are small operations. They don't have the capital to massively expand production even if they wanted to. So you've got constrained supply that can't respond to price signals, and you've got industrial demand that doesn't care about price volatility because production lines can't stop. Tesla isn't going to halt EV manufacturing because silver costs an extra $10 an ounce. Samsung isn't going to stop making phones. Solar installations have government mandates and tax incentives behind them. They're happening regardless of commodity prices. What does that dynamic create? It creates a situation where industrial users are increasingly bypassing the COMEX entirely. They're signing direct offtake agreements with miners. They're securing supply outside the exchange system because they can't risk a shortage shutting down their factories. Think about that for a second. The largest consumers of silver are opting out of the official price discovery mechanism because they don't trust it to deliver physical metal when they need it. Here's where the mainstream narrative falls apart completely. You'll hear analysts say, there's no shortage because look at all the eligible inventory in COMEX warehouses. There are still billions of ounces in London vaults. Technically true, but eligible doesn't mean available. Most of that metal is owned by ETFs like SLV or by private wealth holders who are storing it. It's not for sale at current prices, or maybe it is at much higher prices, but we don't know what those prices are because the paper market keeps everything tamped down. The register category is the canary in the coal mine. That's the metal that's actually backing the system, and it's disappearing. What happens when it runs out? Do we see a nickel-style crisis like the London Metal Exchange had in 2022? Where the exchange literally canceled trades and reset the market because a short squeeze threatened to blow up the system? I went back through the data on above-ground stocks, and here's what nobody's talking about. We don't actually have transparent accounting on where all the silver is. The LBNA publishes vault holdings for London. The COMEX reports its warehouse stocks. But private vaults, industrial stockpiles in China, government reserves, it's all opaque. We're making assumptions about how much available silver exists based on incomplete information. And then there's the substitution argument. Critics of the shortage thesis say if silver gets too expensive, industries will switch to alternatives. For solar, the alternative is copper-plated cells. Technically feasible, but copper oxidizes. For a product that's guaranteed to last 25 years and is installed on rooftops and in deserts, reliability matters more than upfront cost. Most manufacturers aren't willing to take that risk. Could recycling solve the problem? In theory, sure. Electronics contain silver, but the recovery rate is abysmal right now. It's not economically viable to extract tiny amounts from old phones and circuit boards unless silver is trading way higher, like triple-digit territory. At $100 an ounce, the economics might change. We're not there yet, and even if we were, it takes years to build out recycling infrastructure. So here's where we are. 6 consecutive years of deficits. Record industrial demand that's price insensitive. Supply that can't scale up. Inventories draining from exchanges. physical premiums skyrocketing, and yet the price is being held in check by a paper market that trades hundreds of synthetic ounces for every real one. I kept asking myself while researching this, what's the breaking point? When does the physical reality overwhelm the paper illusion? History gives us clues. Look at palladium in the early 2000s. Look at rhodium in 2008. Look at nickel in 2022. In every case, the market appeared functional right up until it wasn't. Then, snap. The exchange changes the rules, or a major player defaults, or a country restricts exports, and suddenly the paper price has to catch up to physical reality in a matter of days or hours. The longer these deficits persist, the more fragile the system becomes. Every ounce that gets embedded in a solar panel or an electric vehicle is gone. It's not coming back. Silver doesn't get consumed in the chemical sense, but functionally it's removed from the market for 20, 30, maybe 50 years until that panel or that car gets recycled. And here's the part that really doesn't add up. If the market is so well supplied, why are retail premiums so high? You can look at the spot price and see $30, but try to actually buy physical silver and you're paying $36 to $40 for coins or small bars. That spread is a screaming signal that physical availability is tight. It's been tight for years now. Dealers can't keep inventory. Mints are running at capacity. Wait times for delivery keep getting longer. The bulls will tell you we're on the verge of a massive squeeze. The bears will tell you there's plenty of silver, and the shortage narrative is hype. I'm not here to pick a side. I'm here to show you the data doesn't support a simple story either way. What I do know is this. We've never had a situation where industrial demand was this dominant, supply was this constrained, and the price was this disconnected from fundamentals. Something has to give. Either industrial demand slows down, which seems unlikely given the push for green energy and AI infrastructure, or supply miraculously increases, which geology and economics say won't happen, or the price adjusts violently upward until demand destruction or substitution kicks in, or the exchanges change the rules to prevent a crisis. Place your bets, but understand the game being played. The paper market isn't broken. It's working exactly as designed, to provide liquidity and smooth out volatility. The problem is that design assumes the physical market is deep enough to handle whatever the paper market throws at it. And for the first time in decades, that assumption is being tested. What happens next? I genuinely don't know. Maybe eligible inventory starts converting to registered as prices climb. Maybe industrial users stockpile aggressively and tip the balance. Maybe a geopolitical event disrupts mine supply from a major producer, and the whole thing unravels in a week. Maybe the paper market holds together for another 5 years through sheer momentum and institutional control. But here's the question I keep coming back to. If you were managing supply for a solar company or an EV manufacturer, and you saw these inventory charts, and you understood how the futures market actually works, would you trust the spot price? Or would you be on the phone with miners, trying to lock in physical supply right now, before everyone else figures out what you already know? Because that's what the smart money is doing. They're not watching the price, they're watching the metal,